Time for our weekly market review where we analyze the markets to see if a correction or crash is coming. And why do we do it? Well, of course, because of risk management, which I rant about all the time because it is actually the real key to success in the markets, at least over the long term. Short term, you can do what you want, but eventually you blow out because risk management isn't always fun, but it's necessary. And I know no one wants to do it, so we'll help do it for you because our goal is not only to grow our money, but protect it too. So in this video, first, we're going to go over the equity markets, of course, the stock market, and we'll see if that correction or crash is coming. Then I got a new sector for you that is likely to outperform, including an individual stock that we're looking at. Could be a good buying opportunity. And then I'll finally talk about the whole GameStop Reddit thing because I've been getting a lot of questions. I know I haven't talked about it yet. So we'll get into that. So first, let's jump into the stock market. And of course, we're using our research from MacroOps, our global macro research firm, the best research around. And as always, let's start with sentiment and positioning. Whole idea to gauge where the market is going is seeing what the other big players are doing. Because how do you make money? Well, you track money flows. You track liquidity because you want to be riding that money wave whichever way it's going. That's how you make money. And sentiment and positioning are a big part of that. And remember, with this type of stuff, it's inverse. So if a bunch of people are bullish and they're all really long stocks, that's actually a bearish sign. And you'll see why in a second as we go through this data. So here's a breakdown of the current euphoric environment that we're pretty much in. And this is coming from Bank of America. There's a record net 19% of fund managers assuming higher risk than normal in the stock market. FMS is the fund manager survey, so it's investors filling that out. And a record number of them are saying they're being more risky than usual. From that same survey, we see a cash level of 3.9% now, which has triggered the sell signal. And what that means is that the cash level that these fund managers are holding is very low, which goes back to what I was saying before. They are positioned heavily in the stock market. They are long. So if they only have a little bit of cash left on the sidelines, there's not much more buying power, which is why it becomes bearish instead of bullish. They're long, but who's left to buy more? That's why you track cash level. If they have a lot of cash on the sidelines, that's actually more bullish because that means there's more firepower to come into the market. The global risk love indicator is in the 97th percentile of history going back to 1987. Again, all just showing all the risk taking that's going on. The EU risk appetite indicator is in overbought territory. Asia and emerging markets, they're showing euphoria for the first time since 2015. And the sell side indicator is at its closest level to a sell signal since the great financial crisis, so 2008. Again, all of this to say that people are very, very long right now. There is consensus that the market is only going to go up. Whenever you have consensus, that's not a good thing because the market likes to do the opposite of what everyone is thinking because of what I just explained, not enough buying power on the sidelines anymore. Along with this, more data to prove this point are record high inflows into equity funds over the last few weeks. Bank of America pointed out that vaccine optimism and the US elections have led to a surge in equity flows, with 2-month flows into developing markets and emerging markets being the highest since October 2000. November alone saw the highest monthly inflow into global equity funds on record, and also over a 3-month horizon, we've now seen the highest inflows into equity funds on record, period. Once again, more data saying tons of money is piling into the market right now because people are so bullish. The Dow Jones transportation average actually issued a sell signal in January. So this little yellow bar that you see highlighted right here, this is a doji. It actually doesn't matter what the name is, but the idea is that it was a potential sell signal. And this was December right here, this yellow bar. And then January's bar, which is this next one right here, closed below its lows of the previous bar, giving us a sell signal. And these are all monthly bars right here. You're looking at it on a broader time frame so we could really see what's going on without the noise. That's the benefit of zooming out. So it does look like a pullback is setting up, but with how bullish the preceding 8 bars were, meaning the last 8 months, this whole thing will likely be bought after a 1 to 2 month pullback and consolidation. So if we're looking at a correction here, it's going to be a minor correction, not the big crash. And it's going to recover because we are long-term bullish. Markets are looking good. See, investors who try to call a top are going to be disappointed because the economic backdrop is not one that you want to try and short or fade or neutral, which is the highest level on record. You can see this right here. We have a very, very strong backdrop right here economically, 92%. This is not something you want to bet against. And a lot of this growth is being driven by all the liquidity that we have in the market. And when I talk about liquidity, I mean like what is the Fed doing? They're keeping interest rates super low. They're constantly printing. Not only that, but the government, they're sending out money. You have this coordinated attack track to push as much money into the system as possible. And that is good for assets. Because if you have a bunch of money chasing after a few assets, what's the price of those assets going to do? It's going to go up. It's the idea of inflation, except in asset prices. So the last 3 decades have not witnessed this combination of animal spirits and a system flush with liquidity. All regions across the world are getting this surplus free liquidity, currently growing at 55% year over year in the US, which is the highest on record since 1980. And it's substantially higher than the 32% growth rate in the aftermath of 2008, the huge financial crisis. So we're blowing that out of the water. We are printing even more today. So long term, looking bullish, but in the short term, we should see this correction. We are at an increased risk of a washout in the short term. Bloomberg found that money managers are more long commodities now than they have ever been in the last decade, which I know it is in the stock market, but it's just another market that's benefiting from this euphoria. So we have a rebounding economy, we have a ton of liquidity, and on top of that, we're getting fewer and fewer COVID hospitalizations because people are actually getting vaccinated, at least in the US. Once again, good for the long-term bull case. Now, like I said, at least in the US, they're getting vaccinated, but in the rest of the world, it's not so great. Only about 10% of the world will be inoculated by the end of the year and 21% by the close of 2022. So yeah, the rollout in the US of these vaccines has not been great, but it has been better than the rest of the world, where it's much, much worse. And you would hope that we were at least better than some of these places, where they have far less infrastructure. Now, if we really break it down to the short term, here's what we're likely going to see. This dip that we're seeing right now will most likely recover and push us to new highs up to this red level right here, which is the 3,950 level. And this is for the S&P, by the way. So the last of the dip buyers will come in at these levels, push it up to this new high, and that's kind of where we'll get a double top on the monthly chart. And this is the same thing that we saw in February of 2020. So last year, a complex double top on the monthly. So if we do get that, that will likely lead to 1 to 2 months of down to sideways chop, with a target for the sell-off in the 3,500 range right here, this green area. So what we're potentially looking at is more bullish action going into the end of February, but after that, we might see that 1 to 2 month dip. Now there's a certain sector that we're looking at that is looking pretty good, especially in this bull market, and that sector is biotech. The whole sector looks to have ended its multi-year underperformance versus the NASDAQ, and these biotechs have some of the strongest long-term looking charts. Illumina in particular is looking good, and that's ticker symbol ILMN. Last month it broke out of its 2.5-year consolidation range. This is a monthly chart right here. Beautiful breakout in a very long-term pattern. So this is definitely one that you could add to your watch list. But of course, make sure your risk management is in place, because like we just said, not saying to take all your money out of the market now, you just got to make sure that you're managing it when things do turn, because we don't actually know if they will turn or when they'll turn. That's why that risk management becomes so important, so you don't have to make these predictions. And I'm interested to see what happens to all these meme stocks in just a minor correction. How bad are they going to get hit? I know I didn't come out with a video while all this was happening, but I actually took a break to rework our YouTube strategy for maybe the 100th time in the last few years. It's just stupid at this point. And honestly, I'm pretty close to shutting down this channel at this point. I got an idea for a different channel that's way more fun. Probably won't work either, but at least it'll be fun. But don't worry, I'll keep making videos here, because whenever I get feedback from someone new who just joins the Fallible team and starts using the Fallible strategy, their feedback is so positive and they're so thankful, just like I was when I started using systems. I'm like, all right, I got to keep making videos, because otherwise these people would have never found me, and future people won't find me either. And then I won't be able to get them hooked up into a system, which makes life so much easier. I swear, it's like getting your first cell phone. How nice was that? So I'll keep making videos. But anyway, I did make a post on the channel talking about the whole Reddit GameStop situation and how I loved seeing Wall Street getting rolled over. Always fun to see them get blown out, because they're supposed to be the guys with the extreme risk management, but oftentimes they're not. Why? Because they just get bailed out when they fail, while the rest of us don't. Now the sad part is that this whole Reddit pump, it worked once, but now all these funds are all over Reddit and social media. They were before, but they're even more so now. And now going forward, they're going to manipulate their own pumps, sending stock prices higher, while instead of them shorting it, they're going to be long. So they're going to play both sides. I read something that this is currently happening with Citadel and silver, where Citadel was trying to make everyone think that they were shorting the silver market when in fact they were long a bunch too, trying to get that squeeze to happen. So the GameStop pump was awesome to see, right? But now the game has already changed, because hedge funds are going to be manipulating every single way that they can. And when you zoom out, this whole thing is so stupid, right? Because it's a bunch of people trying to manipulate things different ways for companies that are pretty much dead. So when you really zoom out and and think about what investing is supposed to be. It's investing in good companies for the long term, right? But I guess you can say none of this is investing. It's all speculation, which is fine to do in the market too. And you can make a lot of money doing it, but you can also lose a lot of money too. And here's the thing, with previous bubbles, we never had social media involved. So now what it looks like is happening is that everything is accelerated so much faster than it used to be because we're all hyper connected now. So that's why you're getting so many of these penny stock pumps. So it's seeming like we're going to see mini bubbles everywhere a lot more frequently. And a lot of people are going to be using the excuse, no, this wasn't a pump, this is just social media. So I'm interested to see what the government does about that, if there will be any more regulations. And I've talked about this before, but all this is happening because these fintech companies have gamified money. They make it really easy for people to come and play with their money in the stock market or whatever other markets, crypto as well. Now, while I agree it's good to give access to everyone, it's also a double-edged sword because when you make it like a game, then people are going to treat it like a game, which goes very against what my Indian fund manager dad always told me. Growing up, he always said, fools and their money always part. And money is not a game, and I strictly believe that. Now, of course, if you want to gamble, that's a different story. You could take a small amount of money, not your life savings, and go play these short squeezes and stuff. But anyone with any real amount of money should not be doing those things. And the issue is if this is all turned into a big game, a lot of people don't know that. You don't know the difference between speculation and betting and gambling versus investing. And you don't know what position sizing is, you don't know how much you should be putting into these crazy plays like GameStop versus something that's actually going to grow your money year after year safely. And that doesn't mean low returns. You can still get high returns, but it's just a different strategy. Because when I think about something like GameStop, even though I love those hedge funds getting blown out, I also think about all the bag holders. You can see it right here. I mean, this chart, right? It's pretty obvious what was going to happen. It got pumped high, and now it's going to collapse. I'm recording this video before the market opens. It's down 43%, and that's not shocking. Of course that was going to happen. But who is holding on to the stock at this point? This whole thing is greater fool theory, right? You buy something with the expectation that someone stupider is going to buy it after you. So when you have something like that, like you do in GameStop, it's going to collapse so fast, and there is going to be someone holding on. And it's not going to be the hedge funds, it's going to be the normal people who are involved. So in every one of these mini pumps that we're going to see consistently now, there are going to be more and more bag holder. And it's bad enough if you invested a couple of $1,000s and you lose all of that. But what's even worse is if you held it through the pump, so that couple of thousand turned into say 100,000 or something, and then you see all of that disappear. That is devastating. Making that big money and losing it, it is not fun. But maybe with all these new people getting introduced to the market, this is the only way for them to learn, by losing. I mean, I hope not. I wish everyone would listen to my preaching about risk control. You know, sometimes I feel like one of those guys in the suits with a Bible in hand knocking on doors. Have you heard the good word about risk management? But here, I'll give you an example of risk management from our system. And you guys know the Fallible system. It's a momentum system where we rotate into the top 5 highest momentum stocks each month. And the stock I'm about to show you right now is mRNA. You can see it's number 2 on this momentum list, meaning it has a very high probability of going up fast because of this little TSI number right here, which is our algorithmic scanner that ranks every stock in the NASDAQ by how much momentum it has. And how is that done? Well, it's done through math. So fun. And Moderna here was actually number 1 on this list for a while, beating Tesla, which is rare to see because Tesla is the god of momentum, at least in the NASDAQ. But look what happened right here. Our system told us to get in on January 4th because the momentum in Moderna was looking good. And from that point, it jumped up over 70%. It was crazy. But that was at the high, right? And the high was January 29th. Look what happened next. It has now fallen, what, like 15%? So what happened? What did we do to control our risk? Well, on the way up here, this 70% run that happened very quickly, and again, this isn't even a meme stock. This is a real stock here. We were taking profits on the way up. We took profits on this day itself, January 29th. And we took profits a few other times as well. And when I say take profits, I don't mean we're taking the whole position off the table. We're just taking a little money off to lock in some gains. And why do we do that? Because realistically, most stocks don't just keep running forever. So if you lock in some gains, you're doing a much better job of harvesting those profits while protecting your downside. And the downside is what I'm talking about right here. This thing collapsed 15% pretty quick. But the fact that we locked in so many profits, we're not hurt by this. It can keep collapsing, and we have a risk point set where even if we sell at that point, we're still collecting a bunch of profits on our position. Why? Because we're not about to be bag holders. And that's the thing, when you go back to GameStop, do these people know how to do that? Even outside of GameStop, do most investors take profits properly? Do they manage their risk properly? No, of course not. That's why so few people are successful in this game, even though it looks like everybody's making money hand over fist right now. It doesn't last because they don't have the right systems in place to actually manage through different market scenarios. Like when this correction comes that we're talking about, I was saying, how bad bad are these meme stocks going to get crushed? They'll get crushed, and you know who will get hurt even more? The people holding them, because they don't have that risk management. Stocks go up and stocks go down. You can't really control that. The only thing you can control is how you manage your positions, which goes into risk management. And that's what you focus on. That's why our system is up 10% right now, while the rest of the market is like 3%. And of course, if you want to learn more about our strategy and risk management, check out this training right here. We go over the whole thing, the same system myself and all our Fallible members use. That way you could use it too. There's going to be a link in this video and down below in the description and comment. Go take that training. You'll see how much I rant about risk control and how important it is, and why we do so much better than the market, and why we're able to do that year after year, regardless of how the market is changing. But click this link right here to go to that training. You're going to be very happy using the Fallible strategy with risk control, just like all our members are. So click this here and I will see you in the training.